It is well known that the recent crisis started outside of Europe. It was in the US where the subprime real estate bubble burst and Lehman Brothers, a major investment bank, collapsed. But these events triggered a financial and subsequently an economic crisis. The crisis reached Europe only in 2008-2009. Also on this side of the Atlantic, a number of banks and car manufacturers had to be bailed out with government money. Tax receipts decreased as a result of economic recession, and government spending widened, not least because of more people receiving unemployment benefits. Since the years 2009-2010, serious doubts rose, especially about the fiscally or economically weaker countries of Europe. Analysts, journalists and investors started to ask themselves, will these countries ever be able to repay the fresh money borrowed during the crisis or their already existing public debt stockpiled in earlier years? As a result, since 2009, the countries of Southern Europe as well as Ireland had to pay higher risk premiums on their government bonds. Countries like Greece, Portugal and Cyprus completely lost access to capital markets. The cost of borrowing money has also increased for private individuals living in Southern Europe. First of all, macroeconomic imbalances are the main cause for the current crisis. For years, countries with a higher degree of competitiveness, such as Germany, Austria and the Czech Republic, have been exporting more than they have been importing and have widened their trade surplus at the expense of less competitive countries. A lack of competitiveness in quite a few countries, including some Eurozone countries, has to do with the fact that local wages rose faster than productivity. It is therefore no coincidence that we cannot, off the top of our heads, name a Greek automobile brand or a Portuguese technology company. Second reason for the crisis. Many countries are facing a sovereign debt crisis. In countries like Japan and the US, but also in Italy and Greece, for years or even decades, government spending has been much higher than tax receipts and other state income. This leads to a mounting stock of debt, both in absolute terms and relative to GDP. In some cases, investors no longer lend money to highly indebted countries. There is a third reason. In some countries, there is a banking crisis. After the burst of real estate bubbles in Ireland and Spain, defaults on loans rose steeply. This in turn triggered the crisis in the financial sector of these countries. Only when it became necessary to bail out their own banks did also government debt rise steeply in Ireland and Spain. In Italy, Greece and Portugal, on the other hand, banks and insurance companies are suffering because of their large exposure to government bonds of their own countries. The combination of a banking and a government debt crisis has led to economic stagnation. The vicious cycle of government debt, banking crisis and lacking growth has uncovered a particular weakness in the concept of the euro. The euro as a common currency of 17 EU member states and the existence of a common European Central Bank blocks two paths to solving the problems that many countries have taken in the past. First, printing money to finance the state budget, which ultimately leads to higher prices, thus dissipating part of the government debt via inflation. Second, the depreciation of the local currency to make exports less expensive and thus regain competitiveness. The economic and financial crisis reveals problems which had in part already existed before. Now the crisis is forcing us to carry out the reforms that had been postponed during economically more favorable times.